Imagine walking into a massive monolithic bank,
Okay, I'm picturing it.
right? So you sit down across the mahogany table from the loan officer, and you ask for a staggering sum of money. Let's say 16,000 crore rupees.
That is a ridiculous amount of money.
It is. And the bank looks at your pristine credit history, nods, slides the paperwork across the table, and says, approved. We have the money right here.
So you sign it and take the cash?
Well, no. That's the thing. Instead of signing, you, the borrower, look at the interest rate, slide the paperwork back and say, no thanks. Your rates are like a fraction of a percent too high. I'll just use my own cash. And you walk out.
Wow. I mean, it sounds completely counterintuitive. Usually the entity asking for the money is totally at the mercy of the market.
Exactly.
But, when you're the sovereign and when your financial operations are being orchestrated by a central bank with this masterful grip on market mechanics, the power dynamic fundamentally shifts.
It totally does. And that scenario I just described isn't the hypothetical. That exact rejection of 16,000 crore rupees actually happened twice last year.
Yeah, it's fascinating.
So today we are doing a deep dive into Chapter 7 of the Reserve Bank of India's annual report for 2025-26. And we're focusing entirely on public debt management.
Right, which is a beast of a chapter.
It really is. Now, if you're listening to this, you are likely preparing for a high-stakes professional examination. You know the pressure. You open up these statutory reports, and instantly you are confronted with just a wall of basis points, constitutional articles, maturity buckets, and, 14-digit figures.
It is incredibly easy to lose the forest for the trees.
Oh, absolutely.
And that is exactly where most candidates fail. I mean, they treat the RBI annual report like a phone book.
Just rote memorization?
Right. They try to memorize the gross borrowing numbers or the yield spreads entirely divorced from the underlying market mechanics. But examiners don't just test your memory.
No, they don't.
They test your understanding of causality. They want to know if you understand why a specific policy choice was made and how it impacted the broader macroeconomic architecture.
Which brings us to our mission for this deep dive. Consider us your senior analysts. We've already done the heavy lifting for you.
We definitely have.
We are going to dissect every framework, every vital statistic, and every legal mandate in Chapter 7 so thoroughly that you can walk into that exam room and just crush the public debt section.
Without ever having to read that dense text yourself.
Exactly. We aren't just going to give you the numbers. We're going to give you the operational logic behind them.
So to set the analytical tone here, I want you to visualize our backdrop shifting. Like, we are no longer in a standard studio.
Okay, where are we?
Picture a high-tech trading terminal. Multiple screens glowing with real-time fluctuating yield curves.
Blow it.
But those high-tech screens are overlaying a massive, illuminated, ancient-looking physical ledger.
Oh, wow. That's a great image.
Because that juxtaposition is exactly what the RBI does. They utilize cutting-edge market mechanics to manage the absolute staggering historic weight of the trillions of rupees on the sovereign ledger.
It's the perfect visual anchor. The RBI is basically the financial architect and the chief plumber for the government.
Yes, the plumber, making sure the liquidity flows.
Right. But before we get into the heavy numbers, you need to understand the core framework that governs everything they do. For the 2025-26 fiscal year, the RBI's debt management strategy was built on 3 uncompromising pillars.
And if you are taking notes for your exam, you definitely need to write these down.
For sure. They are cost optimization, risk mitigation, and market development. Every single data point we discussed today maps directly back to one of those 3 pillars.
So cost optimization is, well, it's about raising funds as cheaply as possible.
Right, getting the best interest rate.
Exactly. Then risk mitigation ensures that the maturity profile doesn't create a scenario where, too much debt comes due at the exact same time.
You don't want a massive bill all on one Tuesday.
Exactly. And the third, market development, is the continuous engineering of the secondary market to ensure there are always willing buyers for government paper.
Okay, so the strategy is clear. But strategy means nothing without authority. You can't just walk onto the trading floor and start issuing sovereign bonds without a statutory mandate.
No, you definitely cannot.
And this is where we begin Section 1 of our briefing, the legal mandate and institutional architecture. Examiners absolutely love testing the foundational statutes.
They do, because the law dictates the boundaries of the market. You simply cannot understand the RBI's borrowing operations without understanding the Reserve Bank of India Act of 1934.
1934. It's fascinating because this mandate predates the Republic itself.
It really is. The institutional architecture has survived the transition from a colonial administration to a modern, massive federal democracy.
Yeah. So looking at the chapter, there are 4 specific sections of the RBI Act that our listener needs to drill down on. Let's start with the center.
Okay, so for the central government, the bedrock of the RBI's authority is found in Sections 20 and 21 of the RBI Act.
Sections 20 and 21. Got it.
These 2 sections legally mandate the Reserve Bank to manage the domestic debt of the central government. The critical distinction for your exam here is the mandatory nature of these sections.
Wait, meaning it's not optional.
Right, it is not an optional service. The RBI is statutorily compelled to handle the center's rupee public debt and manage its banking operations.
Okay, so sections 20 and 21 lock in the center.
Mm-hmm.
The RBI has no choice, and the government of India has no choice. It's a fused relationship.
Exactly.
But India's federal structure is complex. You have 28 states, each with their own massive economies, their own fiscal deficits, and their own borrowing needs. Does the 1934 Act automatically force the RBI to manage the debt for massive state economies like, say, Maharashtra or Tamil Nadu?
No, it does not, and that is the exact nuance examiners will use to trap you.
Oh, really?
Yeah. State debt is governed by a completely separate section, Section 21A of the RBI Act.
21A.
Unlike the mandatory automatic nature of Sections 20 and 21 for the center, Section 21A merely empowers the RBI to manage debt for the states. It is a contracted relationship.
Ah, so it's an opt-in system.
Exactly. The RBI and the individual state government must enter into a specific bilateral agreement.
And this brings us to a highly testable, concrete event from the 2025-26 fiscal year. To really cement Section 21A in your mind, I want you to visualize a very specific signing ceremony that took place on January 5, 2026.
Oh, yes. This is a crucial update.
Picture the flashbulbs, the formal documents on the mahogany table. On one side, you have senior RBI officials. On the other side, representatives from the Government of National Capital Territory of Delhi, or GNCTD.
Right. That January 5th agreement is a massive structural update. On that date, the RBI formally entered into an agreement to carry on the general banking business of GNCTD and manage its rupee public debt.
By signing that document under Section 21A.
Exactly. They effectively added a massive new, highly complex column to that illuminated public debt ledger we visualized earlier.
And the key exam takeaway here is the updated tally. With the onboarding of Delhi under Section 21A, the RBI now manages the debt for all 28 states and exactly 3 union territories.
You must remember that GNCTD joined the framework in January 2026.
Okay, so we have Sections 20, 21, and 21A covering the issuance of long-term debt. But governments, like any massive corporation, don't just need 10-year bonds. They have daily, gritty cash flow operations. How does the RBI Act handle short-term liquidity?
That is governed by the 4th critical statute you need to know. Section 17, specifically subsection 5.
Section 17.5.
Yes. Section 17.5 is what authorizes the RBI to provide short-term credit to these governments to bridge temporary mismatches in their cash flows.
Right, and this specific facility is known universally as Ways and Means Advances, or WMA.
Correct. And the absolute most critical exam-defining detail about WMA under Section 17.5 is the time limit.
What's the limit?
This short-term credit is strictly legally limited to a maximum of 3 months.
Okay, I have to pause and challenge the logic of this because I know a smart listener is wondering the exact same thing.
Go for it.
If the RBI is supposed to be the market developer and the protector of the state's financial health, why is Section 17.5 so incredibly draconian with this 3-month limit?
Draconian is a strong word, but I see where you're going.
Well, think about it. If a state's tax revenues dry up due to an unforeseen regional crisis, why can't the RBI just act as a permanent, revolving credit facility? Why force a struggling state into the punishing open bond market after just 90 days?
It is a brilliant question, and honestly, it strikes at the very heart of macroeconomic stability.
How so?
If we connect this to the bigger picture, the strict 3-month limit isn't a bug. It is the ultimate feature enforcing fiscal discipline.
Fiscal discipline, okay.
Think about the mechanics of Ways and Means Advances. This facility is explicitly designed for temporary liquidity mismatches.
Temporary being the operative word.
Exactly. Let's say a state government has massive payroll and pension obligations due on the 1st of the month, right?
Yeah.
But their major corporate tax receipts don't legally clear the banking system until the 15th.
Right, so they're short on cash for 2 weeks.
Yes. WMA bridges that purely mechanical 2-week gap.
So it is a timing issue, not a solvency issue.
Exactly. It is absolutely not designed for structural deficit funding. If a government could use WMA indefinitely, think about what is actually happening behind the scenes.
They'd just be borrowing forever.
Right. The government would essentially be borrowing freshly printed fiat money directly from the central bank with no intent to repay it. This is the textbook definition of monetizing the deficit.
And that leads to inflation.
Massive inflation. If you monetize the deficit, you inject unbacked liquidity into the system, which triggers an inflationary doom loop.
Okay, that makes sense.
So the 3-month limit is a legal firewall. It forces governments to either fix their internal cash flows, or if they have a true structural deficit, they must go out to the open market, face the investors, and issue long-term bonds.
That perfectly clarifies the mechanism.
Yeah.
So WMA is basically a payday loan to cover a timing gap. It is not a mortgage to build a new highway.
That is a great way to put it. The market must price the long-term debt, not the central bank's printing press.
Okay, that comprehensively covers our legal architecture. We have the statutory mandate, and we understand the boundaries of the RBI's power. Let's transition into Section 2 of our briefing, central government debt operations.
All right, let's look at the actual numbers.
Yeah, the rules are set. How did the center actually play the game during the 2025-26 fiscal year?
Let's start with the sheer scale of the operation. And listeners, prepare to write these down. The gross market borrowings for the government of India through dated securities in 2025-26 stood at 14.61 lakh crore rupees.
14.61 lakh crore. I mean, it's a number so large it almost loses meaning.
It really does.
To put that into perspective, the RBI is essentially raising the GDP of a small nation purely in sovereign debt every single year. And that 14.61 figure, that was an increase from the previous year, right?
Yes, it represented a 4.3% increase from the previous fiscal year's gross borrowing.
But I'm looking at the data, and there's a fascinating divergence here.
Oh, the net figure.
Yes. The gross borrowing went up by 4.3%. But the net market borrowing actually went down to 10.84 lakh crore rupees, which is a 2.6% decrease.
It's a very important distinction.
And before we move on, I want to preempt a trick question the examiners love to use regarding this exact net figure.
You're referring to the adjustments for the active debt management operations.
Exactly. The 10.84 lakh crore is the headline net figure. But if you look at the footnotes of Chapter 7, the RBI makes a very specific adjustment. If you adjust that net figure for, quote, buybacks and switches, the actual adjusted net market borrowing drops significantly to 9,085,637 crore rupees.
And this is where we need to explain the how and the why. Because a candidate who just memorizes 9,085,637 crore won't actually understand what a switch operation is.
Right. They'll just know the number. So let's break it down. How does the RBI execute a buyback or a switch on that trading terminal we visualized?
So a switch operation is really a masterful piece of financial engineering designed for that second pillar we discussed earlier, risk mitigation.
Okay, risk mitigation.
Let's say the RBI looks at their massive ledger and realizes that 3 years from now, an unusually massive chunk of government bonds is scheduled to mature all at once.
Like a huge wall of debt coming due.
Exactly. If they wait 3 years, the government will suddenly have to raise an astronomical amount of cash in a single week to pay back the principal to those investors. That is called rollover risk or refinancing risk.
Because if the market conditions are terrible 3 years from now, say there's a global liquidity crisis, the government might have to borrow at exorbitant, punishing interest rates just to pay off the old debt.
Precisely. You don't want to leave that to chance. So to proactively eliminate that future crisis, the RBI executes a switch operation today.
How does that work?
They approach the institutional investors holding those bonds that mature in 3 years, and they offer them a deal. They say, we will take back those 3-year bonds right now, and in exchange, we will give you brand new 10-year bonds or 15-year bonds.
So no new cash is actually changing hands. They're just swapping the paper. They take the near-term maturity off the table and push the liability a decade into the future. It completely smooths out the redemption profile on the ledger.
That's it, exactly. And because no new net cash is raised to fund the government's current operations, this switch operation has to be subtracted from the headline net borrowing figure to give a true picture of how much new money was actually pulled out of the market.
And that is how you arrive at the adjusted net of 9,085,637 crore.
You got it.
That is a phenomenal explanation. So the FEMPRA borrowed roughly 14.6 trillion rupees gross. But the real story of 2025-26 isn't the volume, It's the cost.
Yes, the cost optimization pillar in action.
The RBI executed a masterclass here. I was looking at the yield dynamics, and the weighted average yield, the way actually softened by 27 basis points compared to the previous year.
Now, 27 basis points might sound like a rounding error to a layperson.
It sounds tiny.
It does. But when you're applying a 0.27% reduction across a borrowing program of 14.61 lakh crore rupees, you're talking about massive structural savings for the exchequer.
Hundreds of crores of taxpayer money saved in interest payments over the life cycle of those bonds.
Absolutely.
And it wasn't just isolated to the new bonds they issued this year. The data shows that the weighted average coupon on the entire outstanding debt stock of the government of India also decreased by 8 basis points.
They are actively lowering the cost of the entire sovereign ledger.
But here's something that stood out to me as slightly paradoxical. The yields dropped by 27 basis points, making borrowing cheaper. Yet the weighted average maturity of the primary issuances also decreased.
Right.
If rates are dropping and debt is getting cheaper, shouldn't the RBI be locking in 30-year or 40-year debt to secure those low rates for a generation? Why issue shorter duration bonds?
This raises an incredibly sophisticated point about yield curve dynamics. You see, the RBI doesn't just look at a single interest rate. They look at the entire curve, from 90-day T-bills all the way to 50-year bonds. Often, depending on domestic liquidity and global macroeconomic factors, the short to medium end of the yield curve, say, the 5-year or 7-year bucket, might offer significantly steeper discounts than the 30-year bucket.
Because investors demand a term premium to lock their money away for 3 decades. They want to be compensated for the risk of inflation eating away their returns over 30 years.
Correct. If the RBI sees that investors are demanding too high a term premium for ultra-long paper, they will dynamically adjust their issuance calendar.
They'll pivot.
Exactly. They will say, we aren't going to overpay for 30-year money. We will borrow in the 7-year bucket where the pricing is optimal. They consciously balance the rollover risk of the slightly shorter maturity against the immediate massive cost savings. It is a highly tactical, week-by-week decision matrix.
Which brings us directly to how these auctions actually function in the real world. You mentioned earlier that the market dictates the terms, but the RBI has a buffer mechanism during these bond auctions. The primary dealers.
Yes, primary dealers, or PDs. They are the institutional bedrock of the primary market.
Who are they exactly?
They are massive financial institutions, mostly large banks and specialized brokerages, that act as underwriters for the government's debt.
Right, so the government announces we are selling 20,000 crore of 10-year bonds today. If the broader market of mutual funds, insurance companies, and retail investors only shows up and buys 15,000 crore, the auction doesn't fail.
No, it doesn't.
The primary dealers are legally obligated, under their regulatory agreement with the RBI, to step in and buy the remaining 5,000 crore. They basically have to swallow the unsold inventory.
In financial jargon, this is called devolvement.
Exactly. Devolvement is the ultimate barometer of market sentiment. If bonds devolve on the primary dealers, it loudly signals that the market appetite is weak, or that the government is trying to sell bonds at a yield the market refuses to accept.
It's a bad sign.
It's a very bad sign.
Yeah.
In the previous fiscal year, 2024-25, there were 2 instances of devolvement. But here's the critical exam takeaway for 2025-26.
What is it?
There were 0 instances of devolvement on primary dealers. 0. A clean sheet. 0 devolvement mathematically proves that the market appetite for Indian sovereign paper was absolutely ravenous. Every single auction cleared naturally.
It's a massive show of strength.
But, and this brings us back to the scenario we opened the deep dive with, the chapter reveals a stunning plot twist.
It does.
Despite this ravenous demand, despite 0 devolvement, there were 2 specific instances during the year where the RBI looked at the bids and explicitly rejected all of them, walking away from a notified amount of 16,000 crore rupees.
And this is where we separate the novices from the analysts. Why would the RBI reject 16,000 crore if the market was begging to buy the paper?
Because the market was demanding a yield the RBI refused to pay. But wait, if they reject the bids, how does the government keep the lights on?
They utilize their cash balances. If we connect this to the broader strategy, this is the ultimate flexed execution of the cost optimization pillar.
All right.
The RBI monitors the secondary market relentlessly. They have an internal valuation of exactly what a 10-year bond should cost on that specific Tuesday. During those 2 auctions, the institutional bidders essentially tried to form a cartel.
Bro.
Yeah, they bid at yields that were artificially high, trying to force the RBI to pay a premium.
They were testing the sovereign's desperation.
Precisely. But because the RBI actively manages the government's cash flow, they knew the center was sitting on highly comfortable cash balances for that specific month.
So they didn't need the money right then.
Exactly. So the RBI looked at the inflated bids, recognized the tactical game the market was playing, and simply said, your rates are out of alignment with intrinsic value. We don't need your money today.
And they walked away.
They rejected all bids, utilized their existing cash reserves to fund the government's immediate operations, and completely protected the integrity of the sovereign yield curve.
It is a phenomenal display of power.
Yeah.
By walking away, the RBI sends a chilling message to the market. We are not desperate. You cannot dictate terms to us.
And it works.
Yeah, the next time an auction rolls around, the bidders will price their bids much more aggressively to ensure they don't get shut out again. It forces the yields down organically.
Absolutely.
Okay, let's pivot and look at the actual cash dynamics we just mentioned. This naturally transitions us into Section 3 of our briefing, short-term cash, ownership profiles, and instrument innovation.
We established that the government uses cash balances to weather auction volatility. But where does short-term liquidity come from on a day-to-day basis? This brings us back to our old friend, the Ways and Means Advances, the WMA.
Let's look at the WMA limits for the central government over the 2025-26 fiscal year, because the data reveals a stark binary split.
It really is a tale of two halves.
Yeah. For the first half of the year, H1, the WMA limit for the Government of India was set at a massive 1.5 lakh crore rupees. But the moment we crossed into the second half of the year, H2, that limit shrank dramatically to just 50,000 crore rupees.
A 66% reduction in the emergency credit limit. To understand why, you have to understand the seasonality of the macroeconomy and government tax flows.
Right, because tax collection isn't a smooth line.
No, it is very lumpy.
In H1, April through September, the government is front-loading its expenditure. Ministries are releasing funds for infrastructure, capital expenditures ramping up. But the massive tranches of corporate advance tax haven't cleared yet. The government is cash poor, but expenditure heavy, so they need that 1.5 lakh crore buffer.
Exactly. But as you move into H2, particularly the final quarter of the fiscal year, the dynamic flips entirely. Corporate advance tax payments flood into the banking system. Personal income tax receipts swell.
So they're suddenly flush with cash.
Yes, the government's coffers are overflowing with natural revenue. Because they're flush with cash, their reliance on the RBI for emergency WMA bridging plummets. Therefore, the RBI safely reduces the limit to 50,000 crore.
It is a perfect reflection of the fiscal cycle. And this overflowing cash in the second half also dictates the behavior of Treasury bills, or T-bills.
T-bills being the short-term instruments ranging from 91 days to 364 days.
Right. I'm looking at the net short-term issuance of T-bills for 2025-26, and the figure is actually negative. It stands at negative 48,672 crore rupees.
Think about what a negative net issuance means mechanically. It means the government allowed 48,672 crore rupees more in old T-bills to mature and be paid off than they issued in new T-bills.
They are actively deleveraging the short end of the curve.
Exactly.
They are retiring short-term debt because their tax revenues are strong enough that they simply don't need the bridge financing. It's a massive signal of fundamental fiscal health.
It's a great sign.
Now, once all this debt is issued, the 14.61 lakh crore in gross long-term bonds, the P-bills, who actually holds the paper?
Right.
If you are taking the exam, you are absolutely going to be asked to break down the ownership pie chart of government securities as of end March 2026.
Let's dissect the ledger. The largest slice of the pie belongs to commercial banks. They hold 34.6% of the outstanding sovereign debt.
Over a third. But let's clarify why. Commercial banks aren't necessarily holding a third of the nation's debt purely out of patriotism or because they love the 7% yield.
No, they are not. This is a regulatory mandate.
Right.
This is driven primarily by the statutory liquidity ratio, or SLR.
Yep.
The RBI mandates that every commercial bank must hold a certain strictly defined percentage of their total deposits in safe, highly liquid assets.
And the ultimate safe liquid asset in the domestic system is a sovereign GSEC.
Exactly. It ensures that if there is a sudden run on the bank has a massive buffer of risk-free securities they can instantly pledge to the RBI for cash.
So banks are at 34.6%. The data shows insurance companies are the second largest holders, sitting at 24.0%.
And to understand this, you need to understand asset liability management, or ALM.
Okay, ALM.
Think about a life insurance company. You pay them a premium today, and they might not have to pay out the death benefit for 30 or 40 years. They have massive, ultra long-term liabilities.
Right.
If they take your premium and invest it in a 5-year corporate bond, what happens when that bond matures? They have to reinvest the money, exposing themselves to the risk that interest rates might have plummeted.
Reinvestment risk.
Exactly. To perfectly neutralize that risk, an insurance company needs assets that match the duration of their liabilities. The only entity that issues 30-year or 40-year risk-free paper is the sovereign government.
That makes perfect sense.
So insurance companies structurally devour the ultra-long end of the GSEC curve to match their ALM profiles.
Following the insurers, we have provident funds holding 10.9%, operating on a very similar long-term ALM logic as the insurers. And interestingly, the Reserve Bank itself holds 10.9% of the debt on its own balance sheet, largely accumulated through its open market operations to manage systemic liquidity.
Yep, the RBI is a major holder.
But let's look at the global angle. We constantly hear financial media obsessing over global capital flows, foreign direct investment, and global bond index inclusions. How much of India's sovereign debt is actually held by foreign portfolio investors, the FPIs?
This is perhaps the most critical macroeconomic stability metric in the entire chapter. As of end March 2026, foreign portfolio investors hold a mere 1.8% of the outstanding debt stock.
1.8%. It is a fraction. If you look at other major emerging markets, say in Latin America or parts of Southeast Asia, you routinely see foreign ownership at 20, 30, or even 40%. Why is this 1.8% figure a massive strategic advantage for India?
Because it acts as the ultimate sovereign firewall against external contagion. Let's run a hypothetical scenario that examiners love to test.
Let's do it.
Imagine a sudden, violent geopolitical shock, a severe escalation in the Middle East, or the U.S. Federal Reserve suddenly hiking interest rates by 200 basis points in a panic. Historically, these events trigger capital flight. Global investors panic, dump their risky emerging market assets, and rush their capital back into safe havens like U.S. Treasuries or gold.
Like the classic taper tantrum scenario.
Exactly. If foreign investors owned 30% of India's debt, their panic selling would instantly flood the market with supply. Bond prices would collapse, yields would skyrocket vertically, and the government's borrowing costs would double overnight.
Potentially triggering a sovereign debt crisis.
Yes. But because FPIs hold only 1.8% in India, their exit is a rounding error. Over 98% of the debt is held in the iron grip of domestic banks, insurance companies, and provident funds who are structurally mandated to hold it.
It is an impregnable financial moat.
Yeah.
You cannot trigger a run on the sovereign ledger if the foreigners don't own the ledger to begin with.
Exactly. The domestic institutions provide immense sovereign resilience.
Now, before we move away from the center, we must touch on instrument innovation. The RBI's market development pillar, it means they aren't just issuing plain vanilla bonds anymore.
No, they are actively tailoring instruments to specific macro objectives. For the exam, note the continued issuance of sovereign green bonds, or SGRBs.
What makes them special?
These proceeds are heavily ring-fenced and specifically earmarked for environmentally sustainable infrastructure, allowing the government to tap into specialized global ESG funds and align the debt strategy with India's long-term climate commitments.
And linking back to the insurance companies we just discussed, the RBI heavily leaned into ultra-long securities this year. Looking at the maturity buckets, a very significant 33.5% more than a third of all the debt raised was in the 15 years and above category.
By pushing the maturity profile past the 15-year mark, the RBI is fundamentally neutralizing rollover risk. They are locking in capital today and pushing the repayment liability decades into the future.
Ensuring stability for an entire generation of fiscal planning.
Exactly.
All right, if you are listening to this, take a deep breath and stretch, because we are crossing the Rubicon. We are moving from the insulated, highly optimized world of the central government into Section 4, State Government Securities, or SGS.
And let me warn you, the narrative fundamentally fractures here.
It really does. If the center story was a masterclass in cost optimization and falling yields, the story of the states is dramatically different and significantly more volatile.
It is a stark contrast. The first thing to understand is that states can no longer rely on massive, unconditional handouts from the center. They are increasingly forced to face the open market to fund their development.
Right.
In 2025-26, market borrowings financed a massive 76.3% of the state's gross fiscal deficit, or GFD.
Over three-quarters of their deficit is funded by going directly to the market and asking institutional investors to buy their bonds. But they can't just do this unilaterally. There is a constitutional mechanism that acts as a gatekeeper.
Yes, and it is a prime target for a multiple-choice question. Highlight Article 293 of the Constitution in your notes.
Article 293.
This article dictates that a state cannot raise a loan without the consent of the government of India if there is still outstanding any part of a previous loan made to the state by the center. Since essentially all states are indebted to the center in some form, Article 293(3) gives the center strict oversight over the gross quantum of state borrowing.
Under the umbrella of Article 293, the gross sanctions given to the states to borrow in 2025-26 were 13.63 lakh crore rupees. And the states actually went out and successfully raised 12.76 lakh crore rupees.
But the volume isn't the problem here. It is the sheer chaotic fragmentation of how they raised it.
What do you mean?
To raise that 12.76 lakh crore, there were 1,055 individual discrete issuances of state government securities, an increase from 835 the previous year. You also saw a massive spike in reissuances, jumping to 217.
Over 1,000 separate bond auctions. Just imagine the market fatigue. And this brings us to the most critical analytical pivot of the entire chapter, the yield divergence.
It's the most important metric.
I genuinely want to push back on the RBI's strategy here because the data is alarming. Earlier, we praised the RBI because the central government's weighted average yield softened by 27 basis points. But in the exact same macroeconomic environment, with the exact same central bank acting as the debt manager, the weighted average cutoff yield for the states actually increased to 7.32%, up from 7.2% the year prior.
The divergence is mathematically measured through the weighted average spread, or WAS. This metric tracks the yield premium that investors demand to buy a state bond over a central government bond of the exact same maturity.
And that spread jumped massively, widening from 30 basis points in 2024-25 to 50 basis points in 2025-26.
It did.
A 50 basis point penalty. I have to ask, isn't this a massive failure of the RBI's market development pillar? If the RBI manages both ledgers, why did they let the states get hammered with a 50 BPS penalty? Why couldn't the RBI stagger those 1,055 issuances better, or use the center's cash balances to protect the states? Why did the RBI allow the states to be punished by the market?
It is a valid critique, but it misinterprets the role of the RBI. The RBI is the architect, but they cannot force the market to ignore fundamental risk.
Okay, explain that.
A 50 basis point spread is not a failure of scheduling. It is the market ruthlessly pricing in two distinct fundamental realities: liquidity risk and credit risk.
Let's unpack both of those. Start with liquidity risk.
If an insurance company buys a 10-year central government bond, they know that bond is traded thousands of times a day. If they need to liquidate it for cash tomorrow, they can sell it on the terminal in seconds with near zero price impact.
Right.
But state bonds, because they are fractured into 1,055 tiny bespoke issuances, are inherently illiquid. They don't trade frequently in the secondary market. If a bank buys a bond from a small northeastern state, they might be stuck holding it to maturity because there are no secondary buyers.
So investors demand a massive yield premium, a liquidity premium, to compensate for that risk.
Exactly.
And the credit risk. Even though states are subnational entities, they don't have the same sovereign power as the center. They can't print money.
Exactly. And the market is highly sophisticated in how it prices this. It is not applying a monolithic, uniform 50 basis point penalty to every state equally. We can prove this by looking at the interstate spread.
The interstate spread.
Yeah.
That measures the difference in yield between the fiscally strongest state and the fiscally weakest state on a standard 10-year bond, right?
Yes. And that spread widened to 8 basis points this year, up from 4 basis points.
Meaning the market is becoming more discerning.
This widening proves that institutional investors are actively doing the forensic accounting on individual states. They are looking at a state's debt-to-GDP ratio, their structural revenue deficits, and the quality of their capital expenditure. They are explicitly not treating a highly industrialized, fiscally prudent state like Maharashtra the same as a state with a bloated structural deficit. The market is enforcing strict financial discipline through the yield curve.
So the RDI isn't failing the states. The market is simply forcing the states to recognize the cost of their own fragmented borrowing and fiscal disparities.
Precisely.
Now, to help combat this liquidity problem, the RBI did introduce a major instrument innovation for state government securities on June 12, 2025. It is an acronym you absolutely must know. STRIPS. Separate Trading of Registered Interest and Principal of Securities.
STRIPS is honestly one of the most elegant pieces of financial engineering in the sovereign debt toolkit.
So to give our listener a concrete visual anchor of how STRIPS actually changes the cash flows of a bond, let's picture a standard, old-school physical paper bond. Let's say it's a 10-year bond paying a 7% annual coupon.
Like an actual certificate.
Yeah, exactly. The physical paper has a main body representing the principal amount, say 10,000 rupees, that you get back in 10 years. And attached along the bottom are 10 little perforated coupons, each representing an annual interest payment of 700 rupees.
That is the anatomy of a standard coupon-bearing bond.
What the STRIPS framework allows a primary dealer to do is take a pair of scissors and literally snip every single one of those 10 coupons off the main principal body. They mathematically sever the cash flows.
It's brilliant.
Suddenly, that single regular bond is magically transformed into 11 distinct, entirely separate zero-coupon bonds. You have 10 zero-coupon bonds representing this 700 rupee interest payouts occurring at different dates over the decade, and one massive zero-coupon bond representing the final 10,000 rupee principal repayment at year 10.
That is exactly the mechanism. Now, obviously, this happens electronically in a dematerialized ledger, not with physical scissors, but the math is identical.
Right.
And why is this critical for the market development pillar? Because it creates deep, tailored liquidity out of standard state debt.
Because different investors have wildly different needs.
Exactly. A pension fund managing a specific retirement cohort might not want annual and interest payments that they constantly have to reinvest at unpredictable future rates.
They just want a lump sum.
Right. They might look at their liabilities and say, we need exactly 10,000 rupees in exactly 8 years. By buying the 8-year Strip D principal of a state bond, they secure a deep discount, zero coupon asset that perfectly matches their liability with zero reinvestment risk.
So STRIPS structurally widens the investor base for state debt, injecting liquidity into previously stagnant issuances.
It is financial alchemy, turning one product into 11 distinct products to meet bespoke market demand.
Okay, we're entering Section 5, modernizing state debt. STRIPS is a great tool, but the RBI knows it isn't enough to solve the core structural problem. The RBI sees the 50 basis point spread. They see the chaos of 1,055 issuances. They know this trajectory is unsustainable for the collective fiscal health of the states.
Yes, major changes are needed.
So they are pushing two massive structural reforms to modernize subnational debt. Let's tackle the first acronym, BIS.
BIS stands for the Benchmark Issuance Strategy. This is the direct structural antidote to the liquidity premium and fragmentation we just dissected.
How does it actually change the mechanics of how a state borrows?
Historically, a state would look at its cash needs and say, we need 500 crore rupees today, so let's issue a random 6-year bond. Next month, we need 800 crore, let's issue an 11-year bond. It was entirely bespoke, creating hundreds of tiny illiquid securities.
Just totally random duration.
Right. BIS forces the states to abandon that bespoke model. Instead, they must consolidate their borrowing and issue massive volumes of securities in specific pre-announced benchmark tenor buckets. For example, only issuing in standard 5-year, 10-year, 15-year, and 30-year maturities.
Okay, so using an analogy, instead of going to a tailor and getting a bespoke suit cut to a bizarre, unique measurement that nobody else can wear, they are forcing the states to buy off the rack in standard sizes.
That's a perfect way to look at it.
By forcing everyone into the 10-year bucket, you suddenly have a massive, highly liquid pool of standard 10-year state paper. Investors know they can easily trade a standard 10-year benchmark bond, which eliminates the liquidity premium and drives the yields down.
Exactly. Consolidation creates liquidity, and liquidity destroys the yield premium. Now, this is a massive operational shift, so it is not mandatory for all 28 states immediately. The RBI is piloting the BIS framework in 2026-27.
And examiners love testing lists. So let's frame this not just as rote memorization, but as an insight. The RBI didn't just throw darts at a map to pick these 9 states. They deliberately selected a mix of massive fiscal heavyweights and highly complex state economies to stress test this framework across the entire spectrum of Indian subnational debt. Which 9 states are in the pilot?
The 9 pioneering states are Andhra Pradesh, Bihar, Chhattisgarh, Kerala, Madhya Pradesh, Maharashtra, Rajasthan, Telangana, and Uttar Pradesh.
You have the industrial engine of Maharashtra alongside the complex agrarian and demographic scale of Uttar Pradesh and Bihar. It is a perfect cross-section.
It really is.
The second major structural reform acronym is MTDS.
MTDS is the medium-term debt management strategy. If BIS is about how you execute the borrowing, MTDS is the holistic, strategic playbook that governs why and what you borrow. The RBI is strongly encouraging all states to adopt it.
It essentially forces a state government to operate like a sophisticated corporate treasury.
Precisely. It forces the state's finance ministry to rigorously evaluate the trade-offs between cost and risk over a 3 to 5 year horizon. Should the state skew towards short-term debt for immediate interest savings, exposing itself to rollover risk? Or should it lock in long-term debt for stability at a higher initial cost?
It's forcing them to think ahead.
The MTDS prescribes quantitative limits and target ranges for instrument structures to ensure long-term fiscal sustainability. It forces states to stop surviving year to year and start planning decade to decade.
It is institutionalizing foresight. Now, before we close out the states, there is a fascinating paradox in the data that we must cover. We just spent 20 minutes detailing how states are borrowing heavily at punishingly high yields of 7.32%. But states aren't just borrowers. They are also massive investors.
Yes, and this is detailed in Table 7.6 of the report. When states receive massive influxes of central devolution funds or advanced tax collections, they frequently find themselves sitting on excess idle cash.
And they don't just leave it in a checking account. They park it in central government short-term paper. The table shows states hold an enormous amount of cash in intermediate treasury bills, or ITBs, and auction treasury bills, or ATBs.
How much do they hold?
Specifically, they hold 2,005,998 crore rupees in ITBs and 63,409 crore rupees in ATBs. That is roughly 2.69 lakh crore rupees in investments.
It proves that states do have significant liquidity buffers, but it also highlights a massive inefficiency.
Right.
If a state is borrowing long-term money in the bond market at 7.32%, while simultaneously parking 2 lakh crore of idle cash in short-term T-bills, yielding perhaps 6.5%, they are suffering from negative carry.
Negative carry.
They are losing money on the spreads simply because their internal cash flow management isn't perfectly synchronized.
The left hand borrows expensively, while the right hand invests cheaply. Fixing that negative carry is exactly the kind of optimization the MTDS framework is designed to address. Right, let us bring it home with Section 6, the 2026-27 Strategic Agenda. If you are sitting for this exam, you know the examiners don't just want to know what happened last year. They want to test if you know the trajectory of the central bank. What is the RBI planning to execute next? The strategic agenda rests on 3 forward-looking pillars.
Pillar number 1 is a comprehensive review of extant schemes for non-competitive bidding in GSECs, T-bills, and state government securities.
The phrase non-competitive bidding sounds almost like an oxymoron in a cutthroat financial market. Explain the mechanics of how that actually works.
It is a brilliant financial inclusion mechanism. In a standard competitive bond auction, massive institutional players, banks, hedge funds deploy armies of quants and macroeconomic models to guess the exact clearing yield to the 4th decimal place.
Right, it's highly technical.
A retail investor, say a school teacher saving for retirement, does not have the modeling capability to specify a competitive yield. If they guess wrong, their bid is rejected.
They get boxed out of the sovereign market entirely.
Exactly. Non-competitive bidding bypasses this entirely. It allows the retail investor to submit a bid for a specific quantum of bonds, say 50,000 rupees worth, without specifying a yield.
So they just ask for a volume.
Yes. They are essentially saying to the RBI, I agree to buy these bonds at whatever the final weighted average price turns out to be from the institutional bloodbath. It guarantees their allocation. The RBI is reviewing these schemes to expand them, remove friction, and make the primary market even more accessible for retail participation.
Which acts as a perfect segue into pillar number 2, which is perhaps the most exciting technological development in the chapter, onboarding retail direct holdings under the account aggregator framework. This is a massive, structural, fintech crossover.
It is the digitization of sovereign debt ownership. The RBI already operates a platform called Retail Direct, which allows individual citizens to open a gilt account and buy government bonds directly from the central bank, bypassing mutual fund fees.
But historically, that platform existed in a silo. You had to log into a clunky government portal to see your bonds. The account aggregator framework, however, is India's revolutionary open banking architecture. It is an API-driven consent layer. By merging the two, the RBI is fundamentally changing the user experience of sovereign debt.
Through the account aggregator, a retail investor will be able to securely, cryptographically share their real-time GSEC holding data with third-party financial applications.
Imagine opening your slick private sector wealth management app on your phone, Right next to your volatile equity portfolio and your mutual funds, the app seamlessly pulls in the real-time valuation of your sovereign bond holdings via the Account Aggregator API.
It's going to be seamless.
It mainstreams government debt. It transforms it from a dusty institutional concept into a standard, highly visible retail asset class. That is profound market development.
And finally, pillar number 3 brings our focus firmly back to the subnational level, sensitizing the remaining states and union territories to adopt the Benchmark Issuance Strategy, or BIS, framework.
So the RBI isn't going to stop with those 9 pilot states we mentioned earlier. Their ultimate stated strategic goal is to scale the BIS off-the-rack standardization to all 28 states and all participating UTs. They want to completely eradicate the 1,055 fragmented issuances and create a unified, highly liquid, and hyper-efficient subnational debt market.
It is a monumental task, but it is the only path to closing that 50 basis point spread and securing the fiscal stability of the states.
Okay, we have covered an immense amount of ground, from the constitutional statutes of 1934 to the fintech APIs of 2026. Let's do a rapid-fire recap for the listener to lock in the most testable, vital statistics and concepts. What are the core pillars they need to circle in red ink before walking into the exam room?
Okay, number 1. The central government successfully utilized its cash balances to enforce cost optimization, dropping their weighted average yield by a massive 27 basis points.
Got it, 27 BPS.
Number 2. The states faced a drastically different reality, suffering a severe liquidity and credit penalty that saw their yield spread over central securities violently widen to 50 basis points.
The 50 basis point spread.
Number 3. The market is ruthlessly enforcing fiscal discipline, evidenced by the interstate yield spread widening to 8 basis points.
The market is waking up.
Number 4. To combat this subnational fragmentation, the RBI is launching the 9-state BIS pilot program to consolidate debt into highly liquid benchmark tenors.
The benchmark pilot.
And number 5. Ensure you remember the legal framework, specifically the January 5, 2026 onboarding of the Delhi government GNCTD under the contractual authority of Section 21A.
If you comprehend the causal logic behind those 5 pillars, if you understand why the yield curve behaves the way it does, and how the RBI deploys tools like switch operations and strips, you are going to absolutely dominate this section of the examination.
But before we sign off, I want to leave you with a broader, unscripted macroeconomic question to ponder, especially as you prepare for the analytical essay section of your exam.
Ooh, what is it?
Throughout this deep dive, we have praised the elegant logic of the newly established benchmark issuance strategy for the states. We understand how consolidating debt into 10-year buckets creates liquidity in a normal market.
Right, the off-the-rack suit analogy.
Exactly. But this pilot is launching in a period of relative domestic stability. Here is the provocative thought for you to analyze. If a massive, unforeseen global geopolitical uncertainty, say, severe systemic energy shock stemming from the Middle East, suddenly strikes the domestic markets, causing institutional capital to blindly flee toward extreme safety, how will this untested BIS framework actually hold up?
That's a scary thought.
Will structurally forcing all states into the exact same standardized benchmark buckets truly protect them from a massive synchronized spike in borrowing costs?
Right.
Or, during a true liquidity crisis, will that 8 basis point interstate spread suddenly violently widen, exposing a massive, unbridgeable gulf between the fiscally prudent states that investors trust and the fiscally reckless states that suddenly find themselves unable to roll over their standardized debt?
That is the ultimate crucible for the RBI strategy. Does standardization protect the weak during a panic, or does a crisis ruthlessly expose them even further because they're all trying to squeeze through the exact same benchmark door at the same time? Think deeply about the mechanics of that scenario as you review your notes. You have the foundational knowledge, you understand the architecture, and you know the stakes. Good luck with your exam preparations. You have absolutely got this. We will see you on the next deep dive.